everyone, and welcome to our first panel in our Inclusive Financial Regulation and Supervision stream. I'm very excited that we're hosting our first Pathway to 17 Summit and that you are with us and joining us in our first summit and in first session of our first panel, rather, of our stream. So our first panel in our inclusive Right. So our first panel for today will be on looking at regulation supervision and how it has to adapt to the fintech innovations we're seeing today. And on our panel today to discuss these important concepts and topics, we have Barry Cooper and Arisha Salman. So I'll start quickly with their introductions, but I think they'll also sneak in a few words here and there about their backgrounds as we continue with our discussion today. So we have Barry Cooper, who's the Technical Director of Payments and Inclusive Integrity with the Center for Financial Regulation and Inclusion, or Cenfri. He's got years of experience in payments from Standard Bank, and by profession he's a lawyer, but I've worked many years with him and I've seen his vast experience and knowledge in these topics that we'll be talking about today, that I know you're in very good hands. We also have Arisha Salman, who is with the World Bank, a financial sector analyst at CGAP, and she comes with the world of experience as I've worked with her with developing the digital financial inclusion supervision course that we've developed for regulators and supervisors exclusively. So as we get into our discussion, I think I'll start with you, Barry, and you can also add to your background as you answer these questions. And by all means, Arisha, feel free to throw in an answer there or two if you do have on Barry's questions. And likewise, Barry, if I ask Arisha a question, please feel free to throw in some answers you may have as well. So these days, we're seeing that our financial authorities are finding themselves having to rethink their stance. The status quo was the financial authority was the policeman. You know, they say yes or no, they approve or decline a license application, and so on and so forth. But now they have to rethink their stance and whether they'll still remain the policeman and be a barrier for innovation because of other underlying reasons, or whether they'll have to find a way to balance both. Be the policeman because they have a mandate at the end of the day, but also be enabler for innovation because they want to see other objectives that they have on their missions or values met. So my question to you, or rather asking in your opinion, as we start off our discussion today, Barry, is how do you think regulators and supervisors can strike that balance of fostering innovation and preserving their mandate, financial stability, monetary stability, and also protecting the consumer?
Nolwazi, that's a critical question, and I think a lot of it comes down to culture. So, for instance, in regulated markets, we see that they target very, very specific outcomes in line with the financial stability oversight. These markets are, by design, meant to be stable, but neither dynamic nor disruptive, and that's problematic because they tend not to be renewing or innovative. And that's by design. It's a culture that's been reinforced since about 1914. It's a culture that's actually stood us in good stead, but it's not something that we can expect to create a space for innovation. It takes a very, very different culture to push the boundaries and to foster innovation. So there's almost like a schizophrenic culture that we need to be in the organization. And over and above that, you've got this market conduct requirement, which requires a very, very different skill set, of a different focus, and also a culture of its own. So to have three different cultures in one institution is particularly difficult. And I think this is the way that you manage these different cultures and give them different focus points and separate their mandates, I think is key to the longevity and to the innovation being allowed to renew these markets. So I think it's important that any one individual focus is aimed at sharpening the other cultures and not blunting them. So it's important to keep all those important cultures viable. So I'd say that it's particularly the mandates, rules of engagement, common ultimate objectives, and the common fate. That should be the mechanism to strike the balance between innovation, stability, an inclusive economy, and ultimately renewal and sustainability. Because culture eats innovation in this regard.
Thank you for that, Barry. And I like that you mentioned that there's the conduct aspect that needs to be considered. So this sort of feeds into my question to Arisha, where we're thinking that, yes, regulation and supervision in this fintech era isn't only about the financial authorities being enablers to innovation, but it's also about thinking about the consumer at every step and this market conduct element being present at every step. So how would you advise authorities balance their innovation enablement with consumer protection, as this might also be quite a tricky path? And may I add, as we continue our discussion, please feel free to add questions in the live discussion pop up on the right-hand corner, and we'll take your questions as well during our discussion, as we can talk on regulation supervision. I know I can. So let me hand over back to you, Arisha.
Thanks, Nolwazi. And yeah, you made some great points, Barry. So I think I can add to those or build off some of the context that you set. And like you rightly said, Nolwazi, when you're innovating, consumer protection risks are arising along every step in the way, rising from complex terms and conditions to the opaque nature of decisions made by artificial intelligence. Consumers are not really sure how their data is being used in a lot of cases by third parties. Now, under this concept of same activity, same regulation, it is important that DFS supervisors and regulators are considering risks across the DFS value chain. It's not just financial service providers, but it's also tech providers, third-party providers, data administrators, that are a part of the value chain, and that's where all the consumer risks need to be considered, the consumer protection risks rather. For any consumer protection activities or for bringing on client trust, we do have certain principles that we recommend, which are standard, which are the provisions of information and transparency, principles around dispute regulation, fraud prevention, data protection, and protection of funds, which needs to be consistent. And some of the activities or some of the recommendations around how these principles can be institutionalized and entrenched are the following. So there need to be licensing requirements that are set up by regulators and supervisors for all entities involved in the value chain. And these licensing requirements would not be standardized, but would depend on risk levels. Two, there needs to be capacity building to oversee existing and new providers amongst the regulators, but also a lot of collaboration within regulators and oversight bodies to develop that enabling regulatory environment. And specifically looking at the FSPs, here are 3 key recommendations. A, it's important that regulators require and check that financial product governance processes and procedures are in place from the beginning to ensure that product design can be improved based on customer feedback. So bringing in customer feedback into the product design element at the process and procedure stage is important. Then there are new techniques like human-centered design and behavioral research tools that can be incorporated within the product design phase by FSPs so that they have mechanisms for gathering consumer feedback. And finally, check that FSPs are developing good management information systems right from the onset, so that they're able to collect good customer data that also allows segmentation and intersectional analysis. I don't want to go on for too long, but there are some important points to look out for while on the data protection front, because that's just so important. So shifting the onus from individuals to providers. It's really the time now to move data protection responsibilities into the hands of the providers, and empowering consumers with modern digital rights that go beyond consent. So some of these actions can ensure that we're balancing innovation with consumer protection.
Thank you so much, Arisha. You touched a lot on a lot of innovations that are happening, particularly that require certain legal infrastructure in place. And I want to move on and touch a bit on that. And I think Barry would love to jump in, especially as I'm going to ask him a question that touches on all of these new innovations we're seeing on a paper that, based on a paper that was published by the BIS and the World Bank in April 2020, and I think is still relevant, on where they published the puffy wheel on the different access modes, technologies, and new products that we're seeing in the fintech era that are relevant for payments, but they're new innovations that will affect how they may need to be regulated and supervised, and that will touch on the legal infrastructure that needs to come around those. So how do you think, Barry, in your opinion, how would you advise regulators maintain a forward-looking approach and stop at, not really stop per se, but try to get a handle on not being so reactive and be more forward-looking, and be up to date with the pace of innovation? We understand that sometimes regulation can't always be prepared. Technology does its own thing. But how can regulation, I guess I'll tie this together with the question I had for Arisha around the capacity gaps, because it will always come back to that. But how would you advise regulators then to maintain a forward-looking approach now that they've seen, okay, this is what's out there? How can we take this piece by piece to make sure that we are forward-looking in our regulatory and supervisory approach in these new innovations?
Thanks, Nolwazi. I think just looking at the PAFI wheel, I mean, in a year and a half ago, it seemed very logical. But now, when I look at it again with different eyes, we're seeing a whole lot of convergence and consolidation of technology. So the boundaries are very, very blurred. And that's a very short space of time. So we're seeing that, particularly central bank digital currencies becoming both a product, a technology, and an access mode. So the boundaries are changing. And how does the central bank deal with that? So actually, if you look, you take a step back and say, what's happening with innovation? Actually, innovation is decelerating over time. And we're actually in a phase where technology is consolidating and converging on past innovations, but it creates a sense amongst us that there's a rapid technological advancement. But actually what's happening is that we're just seeing better utilization of past innovations. We're not seeing a whole lot of new innovations coming in. So that actually is a good thing, because it takes a lot of the unknown unknowns out of the equation. We've got known unknowns, and so we can better forecast and understand and trend where technology is going and how it's evolving. So I think we're in a better position to understand where this is going. It's not just just the infinity that we're staring down. It's actually understandable. So it's important to understand the general direction of where the convergence and consolidation of technologies trend is heading, rather than tracking any single technology. I mean, I agree with the PFI fintech era paper, absolutely, that we should not be tracking any single technology. We should be technologically agnostic. What's more important is the trends in time and understanding how that works in the broader mechanisms. It's key to understand the changes in the market, and particularly the financial system, that create the space for technology, and more importantly, emerging trends in technology that have got the potential impact to disrupt or to systemically alter, change frameworks, change efficiency. So not all technology poses the same risk, and we need to be discerning about if there is technology or if there is a trend, how do we deal with it? And the past decade has demonstrated to pay attention to the convergence of different fields of technology converging is potentially sort of the biggest area, and also looking at new technology layered on existing technology. Like, for instance, we see now with CBDC layering across the whole national payment system, which is an important trend. Once you've identified a material trend, I think it's important to react in time, but in a considered, proportionate, and opportunistic way. You shouldn't wait for the trend to manifest in empirical evidence. You should be prepared for that trend. So it gives you choices. It gives you choices in what way that you are going to push your whatever levers that you have to accommodate or to prepare the market for that trend. So I would say plan to actively leverage innovation efficiencies, and also to leverage it within the central bank and within the regulator, particularly with RegTech and SubTech. It gives you different skills and a different ability to understand technology and to deal with it. You become a lot more equipped to deal with those trends. Definitely planning and piloting, testing and test and learn are all necessary elements that need to find their place, particularly leveraging innovations and efficiencies. Diagnostic research is important to sequence and the leveraging of technology. And also, I mean, there's some big trends that are happening, but none of these should be coming as a surprise. The way things are working is very much in line with consolidation and convergence. So yeah, it's not an easy one, but it's one that you need to proactively engage with.
That's very true, Barry. It's not an easy one, but I think countries need to definitely take prudential steps, consider what's relevant for their context as they try to be proactive and forward-looking in their approach. I've got a question from the participants, and the question, I'll read it directly and I'll pose it to both you, Arisha and Barry. It says, from Gozi, what would you say to regulators such as central banks whom are not agile in ensuring fintech growth? In some African countries, regulation is stifling the growth of fintech. So Arisha, I'll let you have the first go at this one.
Sure. Yeah, this is something that we've been grappling with as well as we develop the course, and there's a lot of talk around how regulators are having to play catch up continuously instead of because they're reacting, like Barry said, to innovation instead of fostering a more holistic and proactive or preemptive approach. At the very onset, I would say that it's more about having a very grounded understanding of what these new technologies entail. It's not about agility. It's even when you brought up CBDCs, I think one of our colleagues was on a panel that where there was a lot of confusion around the differences between crypto. So it happens at a very fundamental level. There's a lack of understanding. So it's not just the agility, but or the ability to adapt to new technologies, but to develop a basic understanding of them. That's one. And second, I would say is it's not like there's a uniform set of regulations that needs to be developed or that requires depth and as much effort for each technology. There are quick wins also, which is the concept of risk-based regulation and supervision, where you actually look at what sort of risk is associated and then adapt regulation according to it. And some of that could involve complex on-site regulation, complex setups of at the systemic level, or the systems level. But some of these could be very easy, and especially if you're looking at regulation around the agent network. It doesn't need to be as agile or as reactive. So there are easier things to do, and I would also bring in RegTech and SupTech. They are relatively low cost, a lot of those technologies, and it's easy to implement some of them, especially on the consumer protection front, on consumer complaints handling. So the Philippines, for example, has introduced a chatbot which takes in complaints, and that again does not require, it's linked to Facebook. So it doesn't require the most complex systems, but it is an easy way to start innovating or start at least reacting to or adapting to rather new regulation. Barry, I'll pass it on to you to add anything.
Yeah, no, I agree 100% with that. I just add on, just in terms of the quality of legislation, regulation, guidance, and also the licensing requirements. Many countries, you find that it straitjackets everything. And you really need to have really principles-based legislation, and that going into risk-based regulation and supervisory guidance. So the quality of that is very, very important, and particularly the licensing regimes and the mutability of those and adaptability. I think is critical, because ultimately they get built for one use case or one case study, and then you expect it to fit into every single use case. And that is potentially the biggest one of the biggest hurdles is this straitjacketing of institutions.
Thank you so much, Barry and Arisha. Gozi, I hope that answers your question. And I think both of you would then, from all that you've been answering right now, will tie nicely. I think I'll pose this last question that I'd written for Arisha to both of you, actually. So, well, Arisha was part of the team that designed and created our new program, which the second course, both courses actually of our new program, in the Digital Financial Inclusion Supervision Program, which is exclusively for financial authorities, your policymakers, supervisors, and regulators. And so from that, this question that I have arose is, so what, and I think Barry can also answer this question on, what capacity gaps do you think are in place, or have you identified that still need to be covered by financial authorities, such that the paradigm shift can be in place from that traditional role that we started off in this discussion of policemen to the more role of enabling policemen, if I can call it that way. A policeman who still is enabling but maintains the mandate.
Sure, I can go first. And a lot of what I wanted to cover on this has been covered through that last question. So it was pretty apt. It was like someone preempted. And I'll come back firstly to fostering a culture that is more proactive and preemptive amongst the regulators, and what tends to happen in a lot of cases is we are looking for very complex solutions, but we need to make sure that the basics are in place. As regulators and supervisors, we don't need to just jump on anything that's new and shiny, but actually look at the benefits of technologies, especially from a financial inclusion standpoint. When we're regulating, does that really facilitate better customer outcomes, better inclusion? So that's one. The second, and that really a gap is supervision is not taking place according to risks. It's pretty uniform. So while we do identify, or while we do recommend same activity, same regulation, but it needs to be risk-based. The third, which is really important, is on data capabilities. There's still a huge gap in data science capabilities, even basic Excel capabilities. I'm not even talking about Python or R. There needs to be an upskilling effort, which is again not very high cost, and that's a pretty low hanging fruit. And finally, we do see pretty big gaps in forums where customers can raise their voice. Because we are recommending, is as we move forward, a customer outcomes-based approach to supervision and regulation. And for that, customers need to be heard. And some of the opportunities for that is by empowering consumer groups to raise their voice and share insights with regulators, but also using new technologies like fintech and regtech to gather customer feedback and create an effective feedback loop. So I do realize we're running out of time, so I'll hand it over to Barry.
I'd agree with that. I just add that yeah, it's about living the culture as well. So the moment I hear a central bank, oh no, we're using regtech to write our regulations, my ears pick up and I think, yes, they're living the culture. And that it's actually difficult. You don't want to undermine the existing culture of financial stability or prudential oversight. That culture needs to be solid, but equally, you need to create a new culture as well in terms of innovation, in terms of renewal of those markets. Those markets are creatures of regulation. They don't act like normal markets. So it's imperative to have those other pieces and to be able to link with particularly other regulators and other areas of government where a lot of the innovation comes from. It's coming from the combining or the consolidation of technologies across different fields. And so I think it's important to have that kind of culture in place as well, and also to have a general community of faith in inclusive markets. I think that's a piece that everybody ignored for generations, and that's the issue that we're trying to clean up now.
Yeah, thank you very much, Barry and Arisha. I see that we're almost out of time, so I think that I will close off our session and thank everyone who has joined us. And thank you for your question, Ngozi. I think it's relevant to understand that sometimes it's not that the regulator doesn't want to enable financial innovation or enable the fintechs. It's that their hands are tied because of the regulations that were set in place, and that changing those also takes time. And so it's not that they don't want to, they want to, and they're actioning it, but it's not happening at the speed that you would like it to happen, because changing regulations or frameworks or guidances or acts take a long time to change. But just so you know, that the reason why inclusive financial regulation and supervision is part of the series of this a stream of this pathway to 17 summit, because regulation plays a significant role, a sort of a backbone role in shaping how providers can perform or supply services in the economy. So if the regulation is not right, then the economy or the providers or the market players cannot thrive. So hopefully you will enjoy the rest of our sessions in the stream, and we'll see you in more to come. Thank you very much, and I've enjoyed this time with everyone. Thank you, Arisha. Thank you, Barry.
Thank you, Nolwazi. Thanks, everyone. Thanks, Arisha.